A lot to get through, Bruce, but we can't talk about the stuff unless we know what you think the curve is going and where the action's going to be.
So the curve is very important, but first on the Fed on that 50 basis point move, there's no question that they made that move, not because the economy is getting weaker. We saw 3.0 GDP today in the second quarter, and we're going to see 2.9% in the third quarter, according to GDP now by the Fed, which is Bostic and Atlanta Fed. So it's looking really, strong from the economy standpoint. Corporate earnings also very strong, and so we believe
they're cutting into strength.
We believe they're cutting into strength. Thank you for saying that, and that's going to help accelerate markets, and it's risk on across the board. And so, what does it mean for the yield curve? Well, I believe the yield curve, Fed funds eventually get to a 3% terminal rate, Fed funds, which puts 2-year notes around 3.25, down from 3.60 right now. But the big move is not 10-year notes, which probably settle in around 4%. So they have nowhere to go. They can go lower for a trade, but they have nowhere to go over the long run. The real trade is the 6.5 trillion sitting in money market accounts that's going to see its rate fall from 5.25 to 3%. And with that decline, there's going to be a lot of money that starts to deploy that's been on the sidelines earning these higher money market rates. And so it's risk on for credit and for markets.
Does that money belong to the credit market?
That money belongs everywhere in terms of risk on. I think the number one place it goes into fixed income like securities and credit, but it also will be deployed across the board as allocators do what they do, allocate capital for what are the better opportunities. And we're seeing this globally, by the way. All the central banks around the world are cutting rates. And so while U.S. GDP next year might come in at 2% or slightly higher, I believe, global GDP 3%, which is terrific for emerging markets, terrific for risk assets like high yield loans, private credit, equities, especially leveraged equities, where if rates come down, those equities fly. Companies that are high yield companies that have been suffering on these higher rates, that when they see lower rates, all of a sudden can generate cash flow to the bottom line. So there's all kinds of opportunities in the marketplace now.
So we'll break that down a little bit more, specifically in the private space. So if you do see that money come out and move a little bit into private credit here, I mean, what areas, where is that money going to go specifically into what areas? Because you still kind of have a lot of unresolved issues of past cycle investments here. So is it going to be a piggyback on that or something new?
I think it's all the above, because I think it's buy all credit generally as a big theme, and within private credit, there's what you're talking about is the opportunity.
But you think investors are going to do more of a basket?
So I think there's going to more of a basket. I think there's going to be opportunistic credit because of all those LBO deals at zero rates that still need to work out, and there's going to be tremendous opportunity there. And in fact, if you can buy into a book of existing, assets, from that vintage, that's probably going to be a really good deal. So number one. Number two is direct lending. With rates coming down, and you know this, the LBO machine is going to start up big because earnings are strong, the economy is strong, and now you're putting in the formula lower interest rates, which we're going to see an enormous boon in leveraged buyouts. We're financing some of that in the direct lending market, and our brethren out there will as well. And then finally, asset-based lending is a big business that's getting bigger, and there's no stopping that train because it's already left the station, and we're going to see more and more of those deals. There's not a week that doesn't go by that we're not doing free transactions of private credit in our asset-based lending business.
What's actually driving some of this activity? And we're going to speak a little bit later here with a real giant in the M&A space. And I'm curious, is this sort of being opened up by the drop in interest rates, or is this more about the read on the economy and the idea that those worst case scenarios that everybody had priced in last year never really came to be?
I think it's both. And I think it's corporate earnings are strong, the economy's doing well, and now you're applying a lower interest rate to finance that buyout. Remember, for every dollar or $1 billion that gets spent on a buyout, $500 million is financed with debt, and that cost of that debt is a lower level, which means it helps accelerate transaction flow. So we're super bullish. Our direct lending team never been busier. It's in the pipeline today. Its deals closed recently, but what's coming is prolific.
You mentioned EM debt. Does that include China?
That includes China. China has been.
You like China EM? You like China debt?
So it's a fixed allocation for us as opposed to an overweight or an underweight. And as it relates to China, and there's been a lot of news about how the equities have flown and K-Web's up and Alibaba and all the big tech companies are up. But the other side is, because it's a tale of two cities, are the banks are deficient. They don't have capital. It's being improperly marked, their loan book, because the real estate market has collapsed. These real estate projects, both commercial and residential, are so far underwater, there's very little to resolve in many of these loans. And so the whole construction cycle of building buildings and building roads has come to an end. And so even the steel mills are in a file for bankruptcy. So while the tech sector is going to come out of this with low multiples and good valuations, and everyone's missing out on this because there's very little capital allocated to it. The other side of the equation is, China is in a very tough position because of geopolitics, because of increased tariffs, despite who's going to be in the White House, coming their way. And so I wouldn't want to be long China. I would want to be long some of the undervalued tech if you're going to go long China. But it's not our trade. We don't invest in Chinese tech. But as it relates to sovereigns, the sovereigns are fine credit. It's the second biggest economy in the world, and it has no problem servicing its debt. And with interest rates coming down, it's bullish for its debt.
We literally only have 30 seconds left, so I hate to throw this at you, but I'm gonna. We had a piece out on the Bloomberg that talked about Citi and Apollo joining forces to work together on like $25 billion worth of deals over the next 5 years. Are you talking to big banks about working on stuff?
So first of all, I love that transaction for Apollo. I think it's great. So they have Athene. They'll be able to feed Athene both on the investment grade side as well as the high yield side and broadly syndicated loans. But those are great partnerships. What I love is like the Marathon Webster Bank partnership, where we're in the middle market space with a commercial bank that has a strong direct lending sponsor coverage team, and we are exclusive partners. And it's a powerful partnership where for our clients, we have the flow of all the private equity sponsor middle market loans, strong covenants, strong financial documents, low leverage ratios that are coming into our book. As a result of that relationship. So the banks and the asset managers, I'm a huge fan of that. I think it works for Apollo when you're talking about upmarket. I think it works for Marathon when you're talking about the value in the middle markets.